Good morning and welcome to today's webinar. I hope you're well and thank you all for joining us today. If we haven't met already, my name is Sonia Fry, Head of Marketing here at Ludlow Thompson, and I'll be acting as moderator for today's presentation. As with previous Market Insight webinars, I also have Stephen Ludlow co-hosting with me today. Hi Stephen, give us a wave.
Hi.
For those of you who don't know, Stephen is our chairman here at Ludlow Thompson. He's been a buy-to-let investor for many years now and is a regular commentator in property-related journals and publications. Previously in our London buy-to-let webinar series, which we started during the pandemic, we've covered the 6 R's for buy-to-let resilience, 5 reasons for optimism, and today's theme is 5 observations on opening up. During this session, we'll be focusing on how the housing market has performed during the first quarter of this year, and discussing how the roadmap to lifting lockdown measures has impacted this in the wider economy, as well as some predictions for the remainder of 2021. This follows the release of our latest London Buy-to-Let review, which we've been publishing every quarter for the last 9 years. The review includes up-to-date data on London rental prices, returns, arrears and voids, along with lending insights and the latest investment opportunities. So if you haven't already, make sure you check out the latest issue. It's always uploaded to our website where you can find it under the landlord section. However, I've also added a link in the chat area on your screen, so you can go ahead and download that now if you haven't already. Following the publication of the latest buy-to-let review and prior to today's webinar, we received some questions for Stephen to answer. So thank you to those of you who sent them in. And as usual, if you think of any questions during the presentation, please use the Q&A function on your screen to send these over. We like these sessions to be as interactive as possible, and we have some really good questions in the past, so please ask away and we will answer as many as we can at the end of the webinar. So that's enough from me. I'll now hand over to Stephen. Stephen, how are you this morning?
Very well, thank you, Sonia. And I hope you're all well as well on this bright sunny morning. And I hope, like us here at Ludlow Thompson, you're buoyed by not only the change in the weather, but the change in the outlook generally.
Yes, I think everyone's feeling the positive changes since more businesses have opened back up, and the change in weather is certainly appreciated by me anyway. I think we're all getting a little concerned that the rain would never go away and summer was cancelled this year, but thank goodness we're now seeing some nice sunshine.
Yes, indeed.
So, getting started on our first observation, which is in regards to the vaccine rollout. In our last webinar, vaccinations were on one of the positive signposts for a good start to the year, and predictions for high volumes to be completed by now.
Yes, indeed. And since then, the rollout of the vaccine rollout's been a notable success. And as we suggested back then in our last webinar, its knock-on effect has had a considerable effect both on the economy generally and London property as well.
So let's look at that in some more detail then.
Great, there's a lot of detail here. I have to say, being open and honest, one of the problems I've had is that this graph changes every day and just moves at such a pace for the right reasons. And I think it's fair to say, you know, although it's happening all around the country and throughout society, it's worthwhile reflecting just for a moment on the pace and numbers associated with the vaccine rollout programme. As of last weekend, 40 million people had their first vaccine, and a further 23 million now had a second vaccine, making up 63 million combined doses combined, and that equates to 70% of the population who've had their initial jab since January. And just to put that in a bit of perspective, I clearly have had my 2 jabs, but my son, who's just 23, had his first jab in the Twickenham Stadium rollout at the weekend. He was one of the fortunate 15,000 to be able to get there. Got a text or an NHS app, got himself over there, got vaccinated. So that's the pace at which it's happening, and that's the span of the population that it's responding to. Really, that's quite remarkable, Sonia.
It certainly is, and quite an achievement, really. But what then has been the positive knock-on effect on the market?
Well, as anticipated in our last presentation, a combination of opening up society and the ongoing and unprecedented injection of money into the economy by the central bank led to a better than predicted 2.1% growth in GDP. And I think we've got a chart there to reflect that. So it led to a better than anticipated 2.1% in GDP by the end of March. And that happened really. You remember last time we spoke about the effect of the accelerators to the economy, putting money back into the economy. So what happened was the government put money into the economy. In fact, what happened was because of the pandemic, people couldn't get out there, put that money into the economy. And so 100 billion of savings have been collectively accumulated by households since February 2020. So 100 billion over the last year. So that money then has started to go to work, and we're seeing the pace of that. Now, originally the government had predicted that the economy will grow by 5%, but the EY Item Club, who independently for 25 years have interrogated the Treasury's data, they're suggesting, as I've shown a forecast there at the bottom of the graph, they're suggesting the economy will grow by 6.8%, so 1.8% above what was originally anticipated. And their belief behind that is what's called consumers' propensity to consume. Now, that effectively means they feel confident enough to start putting the £100 billion to work. And the Bank of England are now saying that they believe that 5 to 10% of individual savings, so 5 to 10% of 100 billion, between 5 and 10 billion, or a shift from 5 to 10 billion, will start acting as an engine for the economy between now and 2023. So some exciting growth on the back of the vaccine rollout, some exciting economic growth. So of course then one says, well, how does that play through to really the theme behind today's presentation is obviously buy-to-let, but also property prices and rental prices. So looking at house prices, 2021, looking at London in Pacific, which such such positive macroeconomic numbers, the numbers we've just been looking about the growth in the GDP and the anticipated growth, then one would be expecting a rise in house prices. Now, perhaps actually London house prices a bit more tempered than one might have anticipated. I know in the last 2 days, the headlines have inevitably jumped at the 10% increase in house prices from the Midlands and particularly the Midlands area and some areas down in the far southwest. So those figures, but actually London is at 2% and the average for the country 4%. So what I find reassuring about the 2% for London is that the Bank of England always set an inflation target of 2% for the economy. So you could say that London house prices are growing in real terms, they're growing with inflation. The advantage of that, I feel, is that, we often on the counter of house price increase, we always talk about house prices bubbles and bubbles bursting and leading to a correction. And therefore, if they're growing at 2% in line with the bank's target and the government's target for inflation, they're growing in real terms and they're tempered in real terms. So I found that encouraging. The other factor, we spent some time last time looking at this, was that there was a belief that the rush in house prices was to beat the stamp duty deadline, which was originally in March of this year. And of course, you all well know now, it has been extended through to the end of June. There was a belief that that was fueling demand. And also the old conundrum that you get talked about, particularly about London property, supply and demand. Well, actually, it's the supply and demand and record low interest rates have meant that actually when we've reached what was described as a cliff edge for the stamp duty holiday, so initially March, then the end of June, prices have continued to grow because of the lack of supply and because of the attractive mortgage rates out there. And we're still seeing our under offer. So our under offer pipelines of new property transactions going under offer, they're still growing. Now, when compared to the UK generally, an idiosyncrasy behind the London market, and this is supported by online registrations from Rightmove and Zoopla, suggests that 70% of buyers look for flats as opposed to houses. Whereas if you look throughout the rest of the country, that trend would be going the other way, more towards houses. Interestingly, though, when we break that down further, 21% of the registrations were for one-bedroom flats in comparison to 39% for two-bedroom flats. So this, of course, probably supports working from home, people looking for additional space as a study room. So interestingly, double the demand for 2-bedroom flats. So something worth bearing in mind if you're in the buy-to-let market and looking to buy, or perhaps bank of mum and dad, you've got children looking to buy, or indeed you've registered today as a buyer yourself. So interesting trait there. And I would just say about our data, because I talked about that 10%. And in the past, I've been doing this research for 9 years now, as Sonia said at the outset. And in the past, tended always to look at land registry data. A couple of problems with that. During the COVID situation, land registry actually, the data wasn't available for the equivalent quarter last year. And then when we looked at it in more detail, because it picks up new build house sales, it can throw the price growth because it takes the residual value of the plots when they're originally sold off, and perhaps then changes between that time and completion. So we found that was misleading. We've reverted now to data from Zoopla. Zoopla, interestingly, takes the under offer of house prices and then looks at mortgage valuations, because quite often, as those of you who buy regularly, or I know we've got colleagues from the banks here today, will know that sometimes there's a difference in the mortgage valuation and the under offer price. And the Zoopla index picks that up. So very happy to report the 2% at this stage.
Thank you for that, Stephen. And on to our second observation, and the phrase green shoots of recovery implies some positive news for the lettings market.
Yep, certainly indeed. Sorry, yes, certainly indeed. I mean, it was, I think last time I was probably a bit down on the letting market on the headline numbers, but I did take some encouragement from what some new research we've been doing recently on what we call the granular stats behind the letting market. So let's look at the holistic figures. Whilst overall London rents have been down 8% year on year, so you tend to see that in the media, we decided to drill down on the last quarter, and reassuringly, London rents have started to grow, and a tempered basis of 1.76% was our research. I was looking at our own portfolio and then using wider databases to look at properties more in central London. But I find, a bit like I said about the real growth in house prices, the 2% aligned to inflation, I find it reassuring that the growth on the rental is mirroring the GDP. And later on, I'll drill down further and come to an explanation of why that is the case at that point. So let's drill down to these granular stats I was talking about. Interestingly, you recall last time, and it's well publicised report, that I believe actually someone has put in some questions about the basis of the report later on, and we'll cover those off, about an exodus from London in terms of London's population. In fact, that was overstated. The exodus from London was overstated for 200,000 people. Now, why is that important? That's important because there's a correlation between the size of London population, the London population, and rental levels. So as the population grows, we tend to see a growth in rental levels. So therefore, if there's such a dramatic fall in population levels, we would have seen a fall as well. And indeed, we did see a fall, but the numbers have been slightly overstated. Now, I think another interesting thing about London's wide range of creative and financial industries were quick to adapt to what's now commonly called a hybrid way of working. Effectively, it meant that employees could use tech and work from home and still fulfill their tasks. That meant that many of the London boroughs had the lowest percentage of employees on furlough in the United Kingdom. And so rather than get to the end of the furlough, as we've seen somewhere else, in some other areas in the country, and then big numbers of unemployment, therefore a big rise in rent arrears, London arrears, rent arrears, and our rent arrears particularly, which we're very pleased about, held firm. And they in fact improved. So they came in as opposed to went out by 0.43%, with just 1.4% of tenants experiencing arrears. And when we look at that compared to the rest of the country and the recent government household resilience study, the government suggested that 9% of renters across the UK were in arrears. So whether looking at Ludlow Thompson stats of 1.4% or London generally, I really think that that statistic underpins the strength of London buy-to-let. Void periods, again, very encouraging data. Void periods have improved again. They bring the average vacancy on our relet properties. So that's properties, the way we're able to track these so accurately, we've been letting those properties in the past and we're now letting them again. And that came down 7.5 days in terms of the speed in which we let them, from 16.7 days in Q4 2020 to 9.3 days in Q1 2021, suggesting that one, there's been a return to London by many. I think that's true. And also remember what we talked about last time was actually when you drill down, the biggest amount of moves in London was from people moving within London. So one, as I said earlier, perhaps there wasn't the exodus, and two, there were moves within London even during the pandemic. Perhaps people looking for more space aligned to the working from home phenomena. So I'm also pleased that there's been an upturn in activity since Easter. There's been 6.5% increase in online registrations for tenants. So all going with that trend. You're seeing rents rise. You're seeing a return in the GDP number. You're seeing the voids come in and therefore the demand. And you're seeing online demand increasing as well. Reassuring as well, when people take a tenancy, they're committing for a longer term in terms of how long they want to stay, live, study and work in London. And our average tenancy agreements have increased 9%, with 89% of tenancies being now over 2 years or more. And that's increased from 80% the last time we looked at the detail. Turning to the London-wide map that you've got here, the graphic, looking at the stats as well. Central London is tilted by weaker rents, prime central London. That's predominantly blamed on the city markets being closed, and also the Airbnb markets still finding a lack of occupancy, although that trend's improving. Some of the central London agents were reporting month-on-month rental growth again, and that would suggest that overseas corporate visitors, and as we've touched on before, particularly international students are arriving. The other thing we're seeing in our locations in City, Docklands and Canada Water, we're seeing city workers in anticipation of an imminent return to the offices. So perhaps many of the banks have said from the sort of magic June the 21st date, people will be back in. We're in fact seeing an upturn in demand, and actually there's value there at the moment because obviously rents have been low, and I think a lot of city workers are sensing the value, making the move now. So I expect those numbers to move on when we next meet at the end of the next quarter. So I think the interesting trend that's developed is actually, whilst inner London, central London saw those fall in rents, I beg your pardon, actually the areas on the peripheral of inner London, which were able to offer a larger space, scope for home and hybrid working at affordable rents, they increased, demand increased, and of course as demand increases, supply of garden flats, for example, still stays static or under pressure. Therefore, rents actually went up in the sort of, peripheral of the inner to the outer London locations. And looking at our own research in terms of the most popular level of accommodation, it won't surprise you that, as with the sales market that we reported on, that the most popular size of accommodation were 2-bedroom flats. So rental market trending with the sales market.
Some fabulous insights there, Stephen. Moving on to our third observation on hybrid working, which sort of links to that. Stephen, you put a lot of emphasis on home working and the new phenomena commonly referred to as hybrid working, as well as the change in tenant preferences for both indoor space, property locations, etc. But basically, do you think it is as certain as it's being portrayed, or do you think that we'll all just go back to working the way we did before the pandemic?
It's a very lively topic of conversation, Sonia, and have to say at the moment opinions are both opinions in terms of people's view on it, and active behavioural preferences seem to be mixed as well. We've looked at a BBC study. You may have well seen this, well publicised, top 50 companies. So of course, big employers, big numbers of employees behind it. And you can see that their opinions were very mixed as well. Some saying they will open gradually, some with no plans to return to the office at the moment. Others, interesting that the 20 who say that staff found it unable to work from home. And I'll relate that to the London market, particularly in a moment. And other firms opening gradually, and some have brought complements back, but won't bring any more back. So you can see it's a mix, and the debate is a mix. But stick to that 20 firms have opened offices for staff unable to work at home. My argument on that is call it the modern aspirational and open cohort that makes up generation rent, as the London professional tenant base is referred to. I think perhaps they want to learn, collaborate, communicate and innovate in a corporate environment, but also they want to be able to unplug at the end of the day. Working from home can't necessarily provide this. I mean, I'm sure you've all been into these modern offices in fintech, proptech, around the Shoreditch area, cappuccino machines, ping pong tables for the unplugged time, breakout areas, and on a practical basis, cycle racks, really good facilities, some with gyms as well. So those offices are more desirable for those living in a commutable distance. And you can then see how this is all joining up together. You can see why perhaps rents on the peripheral inner area of London, which is still very commutable, did start to rise because people, the early adopters, could get back into the office. So I think in terms of London buy-to-let, we may well see a shift back there. On the other hand, if you're doing what's called a hard task, a desktop task, I think that can definitely be completed from a quiet environment working from home. So what policies might then develop? Well, quite often the best way of finding out the way of finding out information is, rather than always looking at data sets, is go and talk to people. So I attended a focus group made up of 20 or so professionals from media, lawyers, surveyors, all at different levels within the organisation. So not just graduate entry, but up. So got some good opinions back, and they're reporting back that clients are increasingly asking for face-to-face meetings, as they require added value, what they refer to as added value conversations, and that's with all attendees making a contribution, something that virtual meetings to some extent prohibit, particularly in the Q&A. I think Q&As lose value. So others suggest that they've adopted policies. They're pretty much saying our employment policy is work where you need to be, when you need to be. I suit the customer, suit the client, and suit the role that you're doing. And indeed, if you look at our situation today, Sonia, of course, you're in the head office there, whilst I'm in the home office location. Whilst obviously the online delivery supports our broad audience. Indeed, it wouldn't perhaps have been possible to have so many attendees today from such a wide geographical span and across such a wide base of the Ludlow Thompson portfolio. So we're very much this morning, and I think other businesses in this context are aligned to the hybrid proposition and will stay aligned to that proposition. The other thing I hear, and again was reported back by the more senior people in the focus group, is call it the rainmakers. So when I say the rainmakers, the magic circle companies, accountants, lawyers, media agencies are conscious that when they win a main contract, so they may win an acquisition contract, they can win that. That could be won virtually, it could be won on reputation, it could be won on previous networks. But they're finding that the related work that can be introduced to other departments, and of course that related work quite often makes up that puts the meat on the bone, makes up the corporate profit. They're saying that they're not getting so much referral work within the firm, suggesting that as we reopen, re-establishing networks and developing new ones through interaction, physical interaction, may dictate, as was said earlier, how we work and where we work.
Very interesting, Stephen. I think the main difference we'll all see is probably the variation in approaches. I think, businesses previously used to sort of follow trends. I think now they'll be sort of coming up with their tailored solutions, whatever works for them, and also, you know, always evolving really and changing as we all have done throughout the pandemic. I think some of the key trends you just mentioned, like more face-to-face meetings, are supported by this next observation, that Londoners are on the move again.
Yes.
So what you can see on the screen here is the Apple Maps Mobility Trends Report. If you haven't seen this before, this data is generated by counting the number of requests made to Apple Maps for directions within London on a daily basis. And what it shows us is the change of movement over time, and also the mode of transport, which is really interesting to see.
Yes, some really fascinating research, and something we'll be keeping an eye on from here on in. What it does is it shows the difference in journey preferences since January 2020 through to the end of May 2021. So you could say, well, along with the opening of pubs, restaurants and leisure facilities, coupled with seasonal trends surrounding the summer, and of course the extended day, so summertime hours, one would naturally see an upturn in mobility in London over this period. But I think it's really very reassuring that the graph is now back to the extent it's mirroring the numbers for May and latter part of April are mirroring those akin to the pre-pandemic environment in January and February 2020. So I think we should take real encouragement for that. And a couple more highlights stand out. One is the growth in public transport. So we're starting to see a growth in the blue line. That's now climbing above the baseline, and again parallel to those Jan-Feb 2020 figures. So that's interesting. And that suggests that the return to London that we talked about earlier, and perhaps the return to the office is happening. And certainly if I look at going back again to my own experiences, March, April, when I was going between the Ludlow-Thompson network, I would be driving. I'm now back on the tube because I'm finding it's taking me 30 minutes on the tube to do a journey that was taking an hour and a half in the car. So I think we'll see that trend increase. TfL responded, not just tube, train and bus, they've responded with an active travel kit. So you can access that online, TfL's active travel kit. And that's putting a greater emphasis on alternative ways of working, such as cycling and particular walking. And walking, of course, stands out from the stats. The investment in London, the Build Back Better campaign by the government, which we know the idea is to extend that out to the regions and the rest of the country. In fact, when you look at the numbers, the last data set on that was in 2020, produced by GLA Economics. And what they told us was, in fact, 25% of the £9.1 billion spent on public transport infrastructure was spent in London, 25% of 9.1 billion. And interestingly, of that expenditure in London, 75% was spent on capital projects. And going back in time, all the time we've done this series, we have reported on the importance of good transport network in London to both rental growth and sales property price growth. So that continued investment, that new investment, reassuring, and that will help underpin rents. But great, really encouraging, interesting research and really encouraging numbers there about opening up.
Definitely. Okay, so on to our final observation, which surrounds the relationship between wages and rents. And if I read you correctly, Stephen, this seems to imply that despite many employees being on furlough, made redundant, unemployed, we're actually seeing wages rising and therefore could soon see rents rising as a result.
That's that's quite correct. I mean, I may be sticking my neck out. You know, earlier we talked about, what was it, 8.9% last time, 10% year-on-year falls in rents. But you'll recall what I said earlier. I think I'm sticking my neck out from a sound base. As I said earlier, that the London boroughs had relatively proportionate to the rest of the country, a low level of employees on furlough, and those that were on furlough, of course, by definition, furlough was 80% of your usual wage. So by returning to work, you're going back to 100%. So we're bound to see wages increase for that reason alone. what happened though during that time, and this proves how sensitive the relationship between wages and London rents is, during that time, in fact, the average monthly rent during the pandemic time accounted for 42% of a single earner's average wage, and that was down from 49% in 2020. So we know the relationship is proved both ways. When wages are coming down, rents came down. As wages start to recover, the argument, proposition I'm putting forward here is that rents will continue to recover as well. The other thing that happened was furlough, of course. In the detail of it, it allowed for employees to take another job with another employer if they could get work. Now that's left to a shift in occupations, and particularly so people in the restaurant, leisure and support services industries in London, a lot of them took jobs with supermarkets who of course were rolling out particularly online delivery, jobs with Amazon and DPD and that sort of thing. Now, of course, when their original employer is opening up again, they're staying with their new employer. They're staying with Amazon, or they're staying with the supermarket chains, perhaps because of more regular rather than shift working. And therefore, suddenly we're starting to see a fall in labour availability. And so because of that, inevitably, when there's a shortage of labour, then wages start to increase. And I think interestingly, you go to the detail on that, again, aligned with the GDP. In February 2021, average weekly earnings in the UK grew by 3.9% when compared to February 2020. And UK unemployment fell 4.9% in the 3 months to February. So as the economy got set for opening up, we saw those two indices change. And we think that those will continue to increase. So when we then look at the graph, what the graph shows there is the relationship between the CPI and rents. And the CPI, Consumer Price Index, is the measure of real wage growth. And as the CPI increases, so do rents. So my argument now is that we're seeing those week-on-week increases in rents, in wages, and we're seeing re-engagement, then we will continue to see a commensurate increase in rents. And that is illustrated by research. The research there was by Legal & General's investment management team. And again, some very, very good and very useful data. The other thing I would take from that graph, interestingly, just an aside really from today's presentation, but when it's compared to the other countries outlined there, Germany, Netherlands, United States, they have quite big, dense institutional ownership of letting property, rental property. And because of that, they perhaps don't get the same market reaction, the market growth that we get in the London buy-to-let market. So generally then that indeed, amongst other reasons, is a very good reason, as I always say at the conclusions of these presentations, back your capital with the capital. And in summary from this morning's presentation, the 5 reasons for optimism we presented last time have started to come to fruition. The vaccination programme is surpassing expectations. The economy is bouncing back with the GDP forecast being exceeded, and capital price growth has held firm, and rental prices are beginning to increase as wages increase. Mobility stats are supporting a return to London and the opening up of the economy generally. So there's a lot there to really be very pleased about. You know, some really encouraging data, some really positive news, and a good visual on where we'll be going into the next quarter.
Very positive way to conclude, Stephen. Thank you. Well, we hope you all enjoyed the presentation and gained some valuable insight into the London buy-to-let market. And now we'll move on to your questions. So first off, we'll start with the questions that were sent in prior to the webinar. So we have one here from Paul, which says, can you give some background to the overestimation of people leaving London, and what is the effect of this miscalculation?
Yeah, thank you, Paul, and thanks for the early question, which was based on the research in the newsletter. Yeah, it's an interesting point, this, that the data was skewed, basically. So the collection of data was skewed in the way that the numbers were collected. And the reason behind that was traditionally it would be done on a face-to-face basis. and they found that really the data set that they were looking at, so in this case they were looking at the impact of economic migration and a return home. In the past that had been done face to face. Well, obviously during the pandemic that couldn't be done on that basis. So that skewed the figures, that 200,000 drift. The other thing that, the other factor that happened was that, of course, when people lost their jobs, they're no longer, they become temporarily unemployed. So say if you were from the EU, you lost your job, temporarily unemployed, it still doesn't mean that you necessarily left London, whereas the predictor behind the research suggested that you had. Another throw really on the way the data is recorded, a lot of it comes from tax data. So that's how it calculates who's working. And of course, tax data does not cover the self-employed workforce, and economic migrants are predominantly overrepresented in the self-employed market. And then, of course, I think it's fair to say that many EU workers were involved in the leisure, entertainment, bar support and London support services industries. And so when you go back to that point about perhaps many were temporarily unemployed while they look for other work, then you can see while there'd been a fall in the data. Indeed, what also happened was that I think the research originally was concentrating on European citizens, EU citizens. In fact, at the same time, other nationalities, in fact, grew. So other nationalities in London grew. EU citizens did fall back, but not by the level it's been estimated there. So what do we see? What's the impact of that trend? Well, I think, and this is interesting, I think that we'll see the leisure industries reopening as we are. We'll see employment, particularly from that cohort of London's population, start to pick up. And the impact on that, and this is something that has been overlooked. People often talk about the Airbnb market suffering a lot of rental falls because of vacancies and voids. Actually, the high yielding buy-to-let market, which is something we particularly look at in our research. So what do I mean by high yielding? Ex-local authority, flats above shops, for example, they also had completely at the other end of the spectrum from the Airbnb market in terms of headline rents, but they actually had proportionally the same rental falls and the same voids as was experienced by the central and Airbnb markets. And as that employment picks up, as those wages pick up, as I said, I expect to see that return, as indeed when we start getting demand, we know we haven't got enough supply of property stock. So 2 or 3 factors there will then lead to prices increasing once again.
Okay, thank you, Stephen. And next we have one from Rachel, which says, reflecting back on the pandemic and previous economic corrections, such as the credit crunch, how would that affect your buy-to-let investment strategy?
Well, of course, we covered off in our first presentation about the 6 R's, repurposing your property for the situation. So what do we suggest there? As indeed earlier we referenced the popularity of 2-bedroom flats, so perhaps buying something with a potential for a home office, small garden or balcony space. But beyond that, because that's obviously well covered, I'd also say, I'd referred earlier to TfL's active travel plan, where you see strong capital investment into the transport infrastructure in London. You tend to see house prices grow, and you also see rents grow as possibly. So I think that's important, travel. The other thing I think we've all learned is that if you were very exposed to one employment market, so perhaps the city market, then 2 things happen really. One, obviously when employees started not to work near their offices, they shifted to outer London locations, therefore we saw voids there. And also the local retail fell away as well. It pretty much closed, whereas on the peripheral, again, the retail, in fact, local retail is very vibrant. So the message there perhaps is look at markets that have more than one key employer. So perhaps a diversification between public sector employment, private sector employment, strong retail and strong investment, capital investment projects, particularly those surrounding transport. And that I think would be sound advice.
Okay, thank you, Stephen. And next up, we have the question, given the growth in GDP, what will happen in respect of interest rates going forward?
Well, obviously, it's a good question, prevalent question, because I suppose the case I've put forward this morning is the economy. As the EY research said, the economy is set to beat its expectations, grow north of 6% this year. So if you've got the economy growing, the price of goods growing, wages growing, then it of course will bring on inflation. Now, the response to inflation traditionally has been increasing interest rates. And I said in the last webinar, I think that what one would be wise to do at the moment, if you're not actually doing it, is to keep a check on it with a view to doing it as soon as possible, really, is consistently fixing your buy-to-let mortgage, because at the moment, buy-to-let mortgage rates are still available at under 2% for 5 years. So that would be some advice there. Keep an eye on that.
Okay, so a good tip there, Stephen. Thank you for that. So let's have some questions from today's audience then. We've got one here from Andrew. What are your opinions on the potential new legislation covering higher EPC requirements from 2025 onwards? The UK generally has a high percentage of older properties, many of which will not achieve a C or B rating, even if improvements are carried out, and will therefore not be lettable going forward. Should landlords be selling such properties now?
Selling or improving, really. I think most of the legislation that's come in has come in for good reason. You know, the EPC is obviously been in for some time, and the levels of compliance have gone up. But interestingly, recently, landlords on today's presentation will know the electrical requirements has come in. Now, I think it's reassuring. You know, I think most buy-to-let landlords are in for the longer term. Indeed, we had some research recently that, in fact, London landlords are in for, on average, 9.8 years. If you invest in your property and you're a long-term landlord, as has been suggested from the evidence that London landlords are, and others aren't prepared to make that investment and they start selling, what will happen, come back to the limited supply point, your rents will increase. And we've seen that there's steady capital growth in the London market. So you will get what, your total returns will also increase. So I think my message would be, rather than consider selling, how could you improve the property? I have to say, from the buy-to-let investments that we own, we in the main don't have new build properties. We have properties akin to this, where we're always keeping a watchful eye on the legislation, on these improvements. But across the years, we've had very few voids, and in the main, we've seen both capital growth and rental growth.
Okay, thank you, Stephen. So just one final question then before we finish up today. If, as you say, the economy recovers, prices go up and rents increase, do you see the number of buy-to-let investors increasing also?
I think the beauty of buy-to-let is, I think the entry costs, I wouldn't be able to say that the entry costs haven't become more expensive. The additional stamp duty tariff, even beyond the 3% introduced back in 2015, the tapering of mortgage interest relief. That has definitely put a cap on new entrants into the market. I think that those in the market, and we see evidence of this, a lot of people leverage their existing equity. We've seen house prices grow even in this last year, where we see rents fall and we've seen attractive mortgage rates. So what's happened is landlords have leveraged their the equity they've got in their property to buy another property. Quite a lot of our landlords, funny enough, they buy another property in the same block, a flat, or the same street that they already own, because they're convinced by the performance. So we see that trend happen quite a lot. And as I referred to within the last question, actually, in the main, landlords are long-term holders of property. They hold the properties on average. This was some research done by Countrywide, saying that over the last, 2020, saw the lowest fall in exits from the sector compared to the last 7 years. And as I referred to, those landlords have been holding properties on average for 9.8 years. So I think that all comes back round to saying buy-to-let really is a long-term hold for seasoned investors. The only caveat I put about entrance into the market is, of course, a lot of people become what are called accidental landlords. And the reason is behind that sometimes is that Bank of Mum and Dad invest in children's property. And then they find that when son or daughter perhaps has graduated or completed professional qualifications, they've seen such good total returns that they hold on to the investment. Similarly, when people first meet together and couple up, sometimes they'll both have a property. When they move outside London, the next move up the property ladder, they leverage one of the properties in order to facilitate the purchase. So we are seeing growth in the market. Our portfolio has grown actually over this period, over the last 2 to 3 months. We've seen a growth in our own portfolio. We're seeing it not necessarily straightforward investment into buy-to-let, but those 2 or 3 reasons that I've just given, that of course effectively it is buy-to-let, albeit under a different identity or name.
Okay, thank you, Stephen, and thank you to everyone for your questions and for interacting with us today. As always, we'd love to hear your feedback and any suggestions for future webinars. So if you have any comments or ideas, please let us know by emailing marketing@ludlowthompson.com. We look forward to hearing from you. Also, if you'd like to refer back to this webinar, we'll be sending a link to the recording. And if you'd like to revisit any of our previous webinars, they can be found on our website under the news section. So thank you all once again for joining us and have a lovely day.
Thank you.